Hello, everyone. Apologies for the delay there. I'm not going to use the word tech in this conversation because I will throw things. Yes, so apologies for the delay. We have had a few tech issues, but hopefully they've been resolved now. So we are live. This is Simon Mishevich and
Louise Mishevich.
And I'm just going to test to see if we are indeed live, Lou. So if you want to just say...
I won't sing. I won't sing. That's always very dangerous to sing. I wouldn't put anybody, including you, through that. So testing.
Oh my gosh. Let's not get you in broadcasting at any point in the future. So if you are thinking of asking questions on this live session, please feel free to do so. We are live, so we will be answering your questions. I'm just going to try one last time of my video settings, see if I can actually get it to work. No, it can't. Restream is not playing ball with my webcam. So we are on a different screen, as you can probably tell.
So probably very fuzzy.
Yeah.
Which is brilliant for my lines.
Yeah.
These lines.
So with that said, what we should do really is get into the chat function. Now it just says here, engagement, but I'm just going to get rid of that. So I'm going to start with the questions. Shall we do that?
Let's go with the questions.
We need some successes, guys, because it's been absolutely shocking today with technology.
Tax is great, tech is not so good.
Yeah, absolutely. So let's go through the first question for this evening, which I'll put on the, hopefully we'll show this one. So let's see if that
does it work.
Does it? Yeah, it does work to a degree. We are on very low definition, I've got to say. So I'll try and tweak the camera in a second. But here's one for you, Lou. So is it possible to transfer my stake, a buy-to-let property I have with my older son, to my younger son? So I'm rather presupposing here that older son has the share of the property with dad.
Yes. And dad's going to give up his share and give it to younger son. So the only people owning the assets will be younger son and older son.
Correct. That's what I'm getting from this. But Alex, if this is totally wax around our ears and nooses around our necks, please tell us, because it's been one of those days. It could easily be that my
it's going to be one of those nights.
I'm even looking at the wrong camera. So I'm going to just put that down because I'm looking at that camera, not the one in front of me now, because it didn't work. So yes. So do you want to start with that, Louise?
Yeah.
What do you think?
There's it's a really interesting question that you ask, actually, Alex, because arguably we need to think about whether your younger son is yet to buy his home, because if he does acquire a stake in that property and then subsequently goes on to buy, say, his personal home, he's going to pick up the additional rate of stamp duty land tax on that next purchase. Even if he's buying with someone who has no property themselves, he's going to sadly be on that very nasty additional SDLT hook by now having this asset in his name, because at midnight on the day of purchasing his home, he'll have more than one asset, and that obviously triggers in the additional stamp duty. So that's one thing to be aware of. The other thing to be aware of, I guess, is that it's clearly a buy-to-let, so he's now going to have to be involved in the buy-to-let regime, which means, of course, self-assessment tax regime, which is not great. And on top of that as well, he's also then got to think about whether acquiring an aspect of that asset is going to cause him any other types of tax issues and how he plans for that. So things like is his will up to date to be able to use the asset and give the asset or his portion of the asset in the way that he wants to. In the will that maybe he's created. I appreciate he's possibly young, given you've called him the younger son. But, you know, we all need to be planning for eventualities. And so is it already captured? And if it's not, thinking about those things.
I noticed that we are very fuzzy.
Oh, my gosh, we are very fuzzy. I'm so sorry, guys.
So apologies for that. But it looks like we're on post office broadband. Comments in the comments box below.
Not pigeon post.
No, almost.
But not quite far off.
Not that far off. I mean, it's pretty fuzzy. So I do apologize if it's not coming across. We've got problems with the camera. Plus, we've got broadband issues.
Tech is not our friend this evening.
Boy. Yeah. It's good what you pay for, isn't it? That's what I always say. So hopefully that's answered that question, Luke.
Yes, maybe.
Maybe. or it has, or maybe.
Well, we'll find out, won't we, from Alex?
Right.
Alex, please tell us more. Have we gone completely on the wrong tangent in trying to answer that question?
It does say can't post the comments so on other streams either, so I'm not sure what's going on with tech at the minute. So let's go to another question, see if we get some success somewhere. Emilia,
Hi, Amelia.
Please help us from this.
Send us your good.
I'd like to know whether holiday lets are better purchased in personal name or limited company for the long term. So you look at your income. It looks like we've got connection issues now going on as well. It's all falling down. But I think in terms of the having properties in your own personal name or limited company, it does matter about income tax and what your future holds and whether you're near retirement or giving up your job. Because if it does, it could still be worth it holding those properties in your own name. But equally, I would say that's very favorable now to invest it into a limited company because you've got better corporation tax rates on the rates of tax, I should say. And then you also got the Section 24, so all interest costs can be offset against your rental income.
Even in personal name.
Capital gains tax, yeah, right.
But of course, this is all assuming, harking back to one of our earlier sessions, you've got to read Help Sheet 253 because there is no such thing from a tax legislation perspective called serviced accommodation. It is furnished holiday lets. And you have to make sure you meet the criteria described in Help Sheet 253. So if you go and Google HES 253 and maybe put HMRC at the end of that sentence, then it will bring up the conditions that you need to be able to meet in order to benefit from all those things that Simon's just described.
Yeah,
so
I mean, I would put the link in there, but I'm just worried that the house would fall down.
We can't go that far.
It's been that bad today with things going wrong. So I think in terms of the that point of view, I think there is a lot of things going right with limited companies. There are other benefits about limited companies that I can't go into this show because it's just too many, if I'm totally honest. So I'm much more angling at the limited company position than I am holding properties in your own personal names, simply because, back to the previous question we had, if you want to allocate property income to another member of your family, you may have CGT issues, right?
Absolutely.
Stamp duty, land tax.
Lovely. Love paying that.
Right. But the point is you could give your children one share of the company and then give them dividends out. How easy is that?
And that triggers no SDLT.
So I think it's really about understanding what the benefits are of limited companies. You do need to get some advice. It's one of those things. It could work for many, but it might not work for you.
And I think, there's an old phrase from the lovely Stephen Covey that said, think with the end in mind. So what is the term strategy that you have? And that long-term strategy could be 20 years in the future, more than 20 years in the future, or 2 years in the future. But understand what it is you want to achieve. And from there, you track backwards and work out which one's going to be the very best solution for you and your particular circumstances.
Yeah, good points. Let's just go over to this one then. So Amelia's got a second question.
Amazing.
So let's go to that question. Let's see if that works out. We're on road now. Can't even get my words out.
That's not tech.
Let's not say it's just me adding enough, I think. So Amelia has asked, are there any tax benefits in succession planning and IHT planning with SA service accommodation and furnished holiday lets compared to buy-to-let and HMOs? I mean, there used to be, Amelia, whereby people would say, well, it's a trade business, therefore you can hand it over by using business. Yeah, well, that's what she's asked for, yeah.
It's also the bit about comparing it.
Yeah, she's talking about furnished holiday. Please don't do start as well. Well, can't
Amelia,
switch, can't switch
we're going
her
to
off.
Argue now. It's not your fault.
So yeah, I can't, so we're talking about furnished holiday lets. That's what the question's about. So in terms of has it got an inheritance tax benefits? Then yes, it has, but not in the same way as it used to. So there was a court case in 2016, 2018. There's been several since then, where the courts have said, well, actually, business asset rollover for holiday lets, because it's not a genuine business for IT, even though it's a trade business for income tax purposes. One office is not talking to the other office, which is income tax and the inheritance tax. So, which is even more interesting, because capital gains tax, you can get CGT rollover relief, which means that they still consider it to be a trade business as well, but not inheritance tax.
So work that one out.
It's not an easy one to work out, if I'm totally honest with you, but there are benefits of using limited companies, even though you've got financial holiday let. So there are different ways of getting around this particular issue of inheritance tax, which I talk a lot about. So hopefully that has given you some indications, but I would say, but you've got two questions, one of them being limited companies and one furnished holiday lets. I would seriously look at limited companies and see how they can work out for you, if I'm honest with you. My thing's gone dead. Let's just kill all technology. Luddite time. Let's take the hammers to the machines. What did they call it? They were Luddites. They were Luddites in Nottingham, weren't they?
Not yet.
Let's say no to technology. Let's go back to the quill.
He's having a moment, people. I'm so sorry.
Otherwise, albeit I would say this would be the end of this show. And good evening from me and good night for her. So let's move on. Andrew says,
hello, Andrew.
Could you read
Save
that
me,
out,
Andrew.
actually?
Save me, Andrew.
Save me. I can't see.
So Andrew is asking, so you're completing a purchase of a one-bed flat next week in Glasgow. You're thinking of providing it to Ukrainian refugees. You have a portfolio of properties and wondering how you might end up being able to against the expenses. So firstly, providing that to Ukrainian refugees or any refugees or anybody in need, what a fantastic thing to do, very human thing to do, Andrew. So my hat off to you for a start. In terms of how it might be treated, it's a great question to ask. So this kind of issue occurs, the closest connection I can pull to it right now is where you might rent to family or friends at a lower rate, so mates rates as sometimes gets referred to. In those scenarios, HMRC have said very clearly that the expenses that you can claim for running that asset or preparing that asset will only be allowable up to the amount of rent that you're earning. So as a silly example, a flat that might normally rent for £1,000 a month, if you let it under mates rate, so to speak, at £500 a month or even less, then the maximum amount of expenses you can claim against that £500 worth of rent is £500. So in other words, you can never be better off than simply breaking even and being at a zero profit. You can't have losses. And you can't set those losses that technically you might have made really against other assets in your portfolio. It is what it is. Having said this, clearly we are in, I hate to use this phrase again, it seems to be overused in the last couple of years, but we're in unprecedented times. And I do wonder whether HMRC will work hand in glove with the government to allow people to not be disadvantaged by offering such accommodation to refugees of any kind. But we are, quite frankly, in that waiting period now to ascertain what government and HMRC will do for individuals to encourage them to do more of this kind of thing and not feel disadvantaged by providing such accommodation. So unfortunately, Andrew, if I'm honest, right now, if I were to apply from an angle of data available from HMRC, you'd actually not be able to claim those expenses above and beyond any rent that you might be earning or income you might be earning from a benefit, so to speak. But I wonder if that might change. I wonder if there might be some leniency.
All right. So the other side to that is it's contacting charities and finding out what they're doing, because you may be able to get some money from charity organisations, which does then allow you not to make profit, but so the idea of doing some good, but being able to then offset your costs against your rental income genuinely. So do reach out to Bureau, local authorities, and because all of those will probably be scripts for your great generosity that you're demonstrating, and they'll simply help you out with whatever they can, because it's going to help. So reach out to those organisations. Best of luck. Let us know how you get on.
Yeah, please do.
Put it in the chat box. Just going on to the what I did well is that I've had to rebooked this session, and it didn't name the word guest David Hand in it, but reuse the old one because the first one. So apologies for that, because David Hanna couldn't make this into another one.
He is coming.
He is coming, guys. But I did change it. But the gremlins are out there for me today. They really are. I've never seen anything like that. When you just get out of the bed and you realize that as soon as you get out of bed, you say, should I just go back in and then stay there? That's what
he's on one of those days. I'm afraid
it's one of those days where just things have not gone according to plan. So let's get to the next question, and let's see what we can do with tax savings. So Anthony has asked, I own 3 properties in the UK. All are rented. One is interest only mortgage. It's coming to an end. I would like to sell. I would like to minimize my CGT bill. How do I do it? I live in Spain. So there you are.
Hola.
Yeah. Oh gosh.
There we go. There's my Spanish for the evening. Hello, Anthony. Hola.
So you're getting worse.
Thanks.
To be honest, yeah.
Not as bad as your jokes.
No, I'm just looking at the fuzziness on the Facebook page.
I'm cool with that because it's hiding my wrinkles.
Yeah. So let's just kick off with this one. It's interesting that you're in Spain because there's a couple of things that's going through my mind, and that's the April 2015. Yeah. So do you want to talk about that?
Sure. So the first thing I'm going to say, which is desperately obvious, and I do apologise, Anthony, is that what I'm talking about now is going to be specific to your UK tax position. If you are a tax resident in Spain, there may still be other tax issues for you with regards to selling an asset. And you may need to reflect upon that with your Spanish tax advisor, having the double tax treaty in place between the two of you, and quite frankly, perhaps a glass of something strong and a paracetamol, but you might need to go through that separately. What I'm going to talk about is the UK tax implications. If you bought the asset before the 6th of April 2015 and you were not resident in the UK, tax resident that is, at the time you sold the asset, then there's a very good opportunity that means any gain you incurred on that asset up to the 6th of April, so pre-6th of April 2015, will be completely excluded from a capital gains tax calculation here in the UK. Hooray! I can hear the poppers going already, which is amazing. The downside is that the way that you work out what portion of your gain is no longer exposed to UK tax has to be done on one of a couple of methodologies. The one that most people have to apply is what's called the apportionment method, where basically you say, well, how much is my total gain? How many days did I own the asset? And how many of those days happened from the 6th of April 2015 as a percentage of the total days of ownership? And it's only that percentage of the gain that is exposed to tax. So that's the apportionment method. You can also do a valuation method, but that would require you to have had a valuation done on the asset on the 6th of April 2015. You can reach out to a surveyor. I would recommend probably someone who is RICS in terms of their qualifications, and establish if they can do, in effect, a valuation for you based on the 6th of April 2015, which is possible, but it can be quite complex. And then you can decide which one gives you the better result. So HMRC allow you to pick whichever of those two gives you the better result, not them, which is brilliant. The only other downside of all of this, of course, is that if HMRC do wish to question any of the data, particularly if you rely upon that latter methodology, which is, of course, relying upon evaluation, then you might find yourself going backwards and forwards quite a lot with HMRC to argue the toss potentially. That's the beauty of using someone like a RICS surveyor to do that work for you, because they are clearly going to be utilising a lot of very valuable information to help you.
Yeah, we probably need to go through that. But I think in terms of that valuation, the one thing I would say about that as well is that you have to be careful not to come back to the UK. And why is that?
Because
within 5 years, by the way.
Yeah, so if you become a tax resident again within 5 tax years of leaving, or rather, yes, 5 tax years of leaving, then actually all of that capital gain that you managed to ignore, so to speak, in my earlier example, becomes due and you must pay it. So it's very important, if you are going to be less than 5 years non-tax resident in the UK, you don't apply this methodology, because it's not for you. All you're doing is delaying the inevitable. And actually what's going to happen is HMRC will add interest on for the portion of time that you should have paid it that you did not. So just be careful.
And the final part is you will be taxable in Spain, because you pay tax on your worldwide income. Not only have you got the UK tax position, but you've also got CGT, which I think they just add it on to your income tax as well. So you just need to do some calculation around that and see how it does affect you. So you will get a tax credit for Spanish tax, but you still will be paying Spanish tax of some nature. And the calculation that they use, funnily enough, may not be the same calculation for the UK. So whereby we just spoke about, oh yes, we could do this to save you CGT. Spanish may just say, well, actually, we want to go back to the actual purchase price versus sales price, and then we'll add on our own rate. So just be careful that when we talk about international tax planning, we have to be mindful of, we can talk about the UK tax perspective, but the Spanish one could well be very different and be more tax than the UK. Yeah,
absolutely. Hopefully that's helped a little, Anthony.
Yeah, I think it has, but I think there's a lot more to be done with the Spanish tax. Okay, so let's just go to Ahmed said, I have an online business and I want to invest my revenue for the limited company. Can I buy a residential property and rent it out with my revenue? Or do I have to pay corporation tax first, then invest it where I left it in the company? I'll kick off with the first bit.
Go.
I mean, if you have a limited company and you buy any property, which will be capital in nature, you do indeed need to pay corporation tax first, because the money that you're buying the property for is capital. So it's not going to be influencing on your revenue. However, what you could do is say, well, actually, I've got my income generated in one limited company. In the same company, I buy a property and I have refurbishment costs, which then helps me reduce my corporation tax overall. Because if you're creating a loss, then that would obviously reduce your profits. So you could do that. But I would really argue against mixing trade and property, if I'm totally honest. So even though there's a tax advantage, there are other issues that you need to consider. First of all, there is risk associated by mixing two companies. One is trade, one is an investment, as an example. You may have issues from a legal perspective if someone should challenge you, your trade business, and then it could affect your asset as well. So I would always say use two companies if you're going to do that. Any other points that you would raise on that one?
I think it is about risk, quite frankly, and VAT as well. I appreciate, I'm not sure what your online business is, but if it's vatable, all of a sudden you're mixing in your bookkeeping vatable items to do with your online business and non-vatable items to do with your rental business. And it can create quite a few headaches for the bookkeeper and ultimately quite a few headaches for you, because you may be asked to clarify, particularly at account preparation time, why certain numbers are what they are. So more often than not, it is, as Simon says, a much more administratively streamlined approach, never mind a risk management approach, to have those assets held in two separate businesses. I won't add any more than that, I think.
No, I do think there's a mortgage point as well. So if you was trying to buy a property inside of a company, then they would want it to be a SPV, or to demystify that, because there's so many acronyms going about limited companies. But SPV just stands for Special Purpose Vehicle. It's a limited company that's designed and set up for letting of properties. So a mortgage company may well dictate to you what the company has set up and how it's set up. So therefore, what you might want to do is then loan money from one limited company to another limited company and then start your investment process. But it doesn't really help you reduce your corporation tax. But if you want to do it that way, it's better than taking money out of a limited company, paying income tax on those dividends to buy the property in your own name. I kind of think there is a great advantage in doing it that way, if I'm honest. But great question. And let's move over to Richard. By the way, if you are watching this live, I'm not sure. I'm looking through please just say hi. For
So we know you're there.
Well, one, we know you're there, but also that we were getting notices saying some connection issues with regards to our portal. So I'm not quite sure what's going on with it, but hey, I'd love to know if you are there. Just say hello. And oh, hi, there we go. There's our first one. So
Hi, Nana.
thank you ever so much for that. I was getting very worried that
hey, we have you.
I'm on isolation in a different world. Right, let's go
on to Omid. Hi, Omid.
Well, no, that's.
Oh no, it's not Omid. Sorry.
Wait a minute.
Oh, come on, tech.
No, this is me. That's not to do with tech.
Oh well, that's a different kind of tech entirely.
Yeah, I'm just old.
Hi, Richard.
I just need winding up. Technology's done that. So Richard has asked, with so many challenges, I've had those today with tech. Shall I not continue this? Right, okay. We've got so many challenges facing the buy-to-let landlord. What positive actions or strategies can we adopt to actually flourish? And that's a great question. I would say watch the property expert panel first Monday of every month, and the property expert panel members hashtag nuggets of gold, because that's going viral now. Hashtag. In fact, what I'm going to do straight up, haggis. I can't talk, you know that.
No.
So I can't even get the hashtag to work anymore. This is just shocking. So
all those fizzy
nuggets, it's not that, is it? Let's be fair. Nuggets of gold. There you go. So there's my little hashtag to everyone. If you can just put that out there, that'd be good. Because we want that to be going viral on LinkedIn, Facebook, YouTube, and tag all the property expert panel members in. But to Richard, to answer your question, I think we are not the best people to ask. I think it is something that you should be posting on the property expert panel and get a good mixture of views, rather than just one couple, if you like.
Yes.
So that's my view. That's and we're going to leave that there.
And what I would say is, just on a general perspective, there are there's so many people making ridiculous amounts of money out of property. It's possible. And it's possible to do it, law-abidingly as well. You don't have to do anything silly to make it work. And we will be delighted to spend time. We do it every day with our clients, working through strategies and plans, short-term tactics, as well as longer-term strategic positioning. It's there for the taking. Yes, HMRC and the government, you might argue, have given it a right old good old hammer over the few years. But we're not on our own. Lots of different industries have had this. And there are super methodologies to follow to make sure you really are wringing out every last drop of tax efficiency.
Can I be honest, though? And I get this in terms of, HMRC have hammered landlords. And it's easy to feel victimized. But I equally kind of just want to remind people the return on investments from property, the capital growth from that investment that you have, cannot be obtained from any other type of asset. I see the boom and bust of cryptocurrency and people losing vast amounts of money on Bitcoin. And I appreciate people are going to go, what do you know about Bitcoin's cryptocurrency? And then there's a thread that always follows to say, follow this person above. And it's a bit of a scammy thing to do, but on YouTube. But there's a lot of people that will invest in different types of assets that make a hash of it just as much as you can make success of property. So bricks and mortar are foundational to this country and won't be anything else, whereby stocks and currency, which are paper-based stuff, can be switched on overnight. I mean, we've seen that with what's going on with Russia and Ukraine, and the stocks of certain assets are just overnight disappearing.
Wiped out.
Which you don't get that from property. So I get it, Richard, that sometimes we feel the pinch and we feel the pressure of stuff, but actually knuckle down, because property is here to stay, clearly, and you can make good money from it. I mean, we were talking about charities, and one of our clients, Dan, I shall call him Dan and no more, but a good friend of ours, funny enough, and he is making great money because he's doing social stuff and bringing on charities and governments, local authorities into the mix, talking to those organizations, and you'll be amazed at actually there are a lot of opportunities out there. You just need to look around. It's not just all about residents and standard buy-to-let vanilla properties. Use your imagination and you'll be amazed at what you might be able to find out there. And we just watch a few YouTube videos which are different from the normal, you know, the HMO and the service accommodation. They've got their place, but there are other types of strategies you can deploy. Sorry, Louise, you say.
He's gone off on it. He's gone off on it, Richard.
I did.
I'm hopeful that you're already in the asset class of property because of the way that you're asking the question. It like anything in life, you have to work hard at these things. I know. And sometimes it feels like you're working ridiculously hard, harder than perhaps other people who seem to be making money around you on other things. I tell you now, long term, this particular asset class seems to outperform everything else, in my humble opinion, certainly from my experiences and certainly from many of our clients. So keep at it and keep asking the great questions.
Yeah, absolutely. I'm going to let you read this one, Lou, because it does require a bit of focus on the order writing. There you go. Take it away.
Okay. Hi, Sushila. So under what exceptional circumstances can you claim a refund of the higher SDLT rate if you are not able to complete within the period of time that HMRC normally give you, I guess is the summation of it. I would say you need to go chat to HMRC, have a really good quality conversation with their teams to establish the reasons. They have very public types of reasons to the COVID-19 could be a very reasonable reason. I appreciate it's not visible necessarily on my screen. It might not even be visible on everybody's screen. But you go on, I know, to comment about the fact that your brother couldn't serve the terminations in the timescales he wished to because of COVID-19. He couldn't arrange viewings, etc., etc. And so COVID-19 has genuinely had an impact at the pace at which he was able to complete the works he wished to do, which was to sell the asset. So I think there is a very strong chance those kinds of reasons would be very much listened to by the Stamp Duty Land Tax team. So you need to go and have a conversation now with HMRC, or rather your brother needs to go and have that conversation with HMRC.
And underneath the video description, maybe a survey, which I can pull up in a second while you talk, about if you get no success, then maybe David Hanna, who was going to be on the show, is going to be postponed for tonight, but he certainly can help you. So I can give you an online form link in a second. Pray that the whole system doesn't fall upon me when I do that. It's like
positive vibes.
It's like a house of straw.
It's all working. It's all working
at the minute.
Honest.
We're going to move on from that then, because I don't certainly have any answers for that. Any more things to say? If you are watching live, do make sure that you post your questions.
And what's that little thing there that you need to do?
Yes. Don't send icons in the comments box. That's not what we want. It's definitely a like on the actual YouTube video, underneath the Facebook, LinkedIn, wherever you are watching. Please put a like there and subscribe to the YouTube channel, of course. Let's move over to Luke has asked, how much tax do you pay on dividends after April 2022? So obviously we're now talking about income tax on dividends, and everything is going up, isn't it? It's been like utility prices and fuels and fuel filling up your car. It's all going up, Lou.
It certainly is. Now, just to be clear, the rate for dividends is changing at midnight, the 5th of April 2022. It's not the end of April, just to be absolutely clear. So if you are thinking about loading yourself up with some dividends to maximize your utilization of basic rate tax brackets, for example, or the £2,000 allowable amount of tax-free dividends, and you want it to land in the 21-22 tax year, do not delay. You only have until midnight, the 5th of April 2022, to get those loaded in. From the 6th of April 2022, then the dividend rates in terms of the tax rate is rising for all three tax rates for dividends by exactly 1.25%. So that means if you're a basic rate taxpayer on your dividends, then no longer are you paying 7.5, you're paying 8.75. If you're a high rate taxpayer on your dividends, no longer are you paying 32.5, you're paying 33.75. And if you're paying at the additional rate, sadly, that really kicks up a notch from the 38.1 to 39.35. Gosh, my
Yeah,
brain
it's just
wasn't
add
working
1.25%. Yeah.
then. So it really is kicking up a notch. It doesn't sound a lot in the grand scheme of things, but every penny counts. So if you are thinking about doing your dividends or adding more dividends before the end of current tax year 21-22, get them done before midnight, the 5th of April 2022, please.
Yeah. And so Sheila and anyone else, you would notice I've just put a link in there for
Refunds.
It's not working with the old tech for me at all. I'm going to go back to the old accountant. I'm going to be going back to my old traditional accounting.
What you need
abacus,
to do.
And what's the old 486?
Oh, I don't know.
For the tower.
Yeah.
Big keyboards, clunky ones.
You just need to stand up, twizzle round 3 times and say jinx, 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 according to our son.
Yeah.
There you are. That sorts it all out.
It sorts it all out. There have been absolutely no issues at all.
Happy days.
So hopefully if you need to get some SDLT refunds, then feel free to use that link and that will help you out. So thank you very much for that. We've got Ben, and again, guys, you're all pretty quiet tonight. So if you do have any questions, then please do comment with your questions. We will answer them. We are here live, but we are here live. So if you could do that, that'd be fantastic. So Ben has asked a question. Let's see if, brilliant. Thank you, Sheila. You're very welcome. Let's go to Ben's question. How do you minimize inheritance tax using trusts?
Ooh, good question. Good question. There's a variety of strategies. The obvious one is, and forgive me for saying it's the obvious one because I appreciate you asking the question, but one of the first things that a trust can do, of course, is if you move an asset into a trust and survive at least 7 years after giving that gift into the trust, then upon your demise and death, your inheritance tax will not include any of those assets in that trust, assuming it's the right kind of trust. It can't be a bare trust. It has to be something like a discretionary trust or an interest in possession trust. But so long as I say, as you survive 7 years after making that gift, then quite frankly, there's a very strong chance your inheritance tax, if there is any to pay, will not take into account those assets inside that trust. Happy days. That's number one.
Yeah.
Want to go on to number 2?
Well, what's number 2?
I was going to talk about potential, and it's not quite inheritance tax, but there are ways to put assets inside a trust and then move them out of the trust eventually. And I say eventually, not meaning multiple years, but perhaps 1 or 2 years at maximum. But there are ways to move assets through a trust to move them to whoever you want without it triggering particular types of tax, including, of course, if you survive the asset for 7 years, inheritance tax. So it doesn't have to stay in a trust necessarily, but a trust can be a vehicle to help you minimize your inheritance tax if you've got sufficient time to plan for that.
And I think in terms of trust, it's great asset protection using discretionary trust, but they are very complex in nature, and you do need to get a good understanding of those. But ultimately, what you're trying to do is relinquish your ownership of those assets and make sure that they are passed over through to the trust, and that you don't retain any entitlement. So there are a lot of people, even on TikTok, interesting enough, where I'm on TikTok and I was watching people on TikTok saying about putting assets into a trust and then still living in it. I was like, well, that actually is a gift with reservation straight away and avoids the whole point. All you've now done is spent £3,500, £4,000 on a trust that is nil and void. So well done. So just be careful of watching things like TikTok, because there's a lot of people that are on there willing and good meaning, but actually just factually incorrect. So you do need to be a bit careful of that. But I think there's still things that you can move it to a trust. You relinquish and control, and then it starts to reduce your inheritance tax liabilities. So there's a lot of ways to reduce IHT. We can go all day about that, to be honest. But using trust, great way of doing it. But make sure that you don't have any entitlement to any assets you put in those trusts, because otherwise it will cause you pain. Moving on, and again, I will re-echo, guys. You're all very quiet, and I'm not seeing enough likes on my YouTube.
Goodness gracious.
Yeah, not enough at all.
Click
In
that
fact,
like button, please.
It's disgusting.
If you like it, of course. I mean, don't click it if you don't like it, but I hope you do like it.
Well, why would they be here? You know, if they didn't love it. You know, well, I mean, what's on TV? Liverpool is on TV. That's what's on TV. I'm missing
we've got
Liverpool
him going.
You know, so I'm missing all of that for everyone now. You know, it's a real shame. So yes, so let me just get onto the next question, which was, let me just have a look. Oh, so we have got a question here. How do you minimize inheritance? Have we done this one? I don't think we have.
No, we haven't done this one. Hello, Ray.
Ray has asked a question. How do we minimize inheritance tax by leaving the country? Right. Well, let me start then, because Louise didn't want to be partaking in this particular question. So let's think about this. What is inheritance tax? So tax on death, basically. And each person has £325,000 allowance. You might have a home nil rate band as well, depending on the valuation of your home. It could go up to £500,000. But ultimately, you could pay 40% tax on any excess. If you're a couple, husband and wife like this, then no, we're not specifically like this. You know, it could be any type of couple. Let's not get into that. But you know, if you're a couple, husband and wife civil partnership, that kind of thing, then you can get up to £1 million worth of assets, which would be free from an inheritance tax. That's provided you've done nothing else. Now, leaving the country, that's an interesting one. And I talk to clients that are moving over from Hong Kong, where there's no inheritance tax. And I speak to people from the US, whereby the estate tax doesn't kick in until 12 million. And you kind of think, why are you coming over to this country for? One, it rains a lot and you need an umbrella. You have plenty of floods, and you've got inheritance tax. I mean, it's a three combo that just doesn't really worth talking about. But you know, you could wait and say, well, actually, let's leave the country, sell the assets. You might have a CGT problem, but at least CGT is 28%, not going to be, you know, 40% if you're selling property. And you leave the country and you only pay inheritance tax on your UK assets that you leave behind. So you could set up shop in a different country whereby there's low inheritance tax rates, and take your money over there, reinvest, and then set up life. And that's pretty much how you would do it, in all honesty. I don't know if you want to add to that.
I don't think there's an awful lot to add to it, other than to say, as we talked about earlier about the Spanish capital gains tax issue, just because you're looking to get out of inheritance tax from this country doesn't mean you're necessarily getting out of inheritance tax from the country in which you now reside. So just be careful that you're not jumping from one frying pan to the other in your planning. There are certain circumstances as well. If you are going to keep assets in the UK, but you're going to keep them at a relatively low amount, so for example, say within your £325,000 nil band, so that even if you're at your death, there wouldn't be any inheritance tax on it. Keep in your mind's eye that if you're in the process of selling down assets to get to that point, there are at times inheritance tax stickiness, UK inheritance tax stickiness. That means up to 3 years after you've left, you could still be on the hook for inheritance tax on your worldwide estate. So here in the UK, that is. So the fact that you left the UK 2 years and 9 months ago, and you've got multiple amounts of assets all over the world now, but only a small amount in the UK, don't think you're sitting pretty until you've got to 3 years in some instances. So do your research on this. And as I say, just be careful where you're moving to isn't going to have a more painful inheritance tax regime than the one that you're leaving.
Yeah. And what I would also say to you is you may have foreign assets. So you might be coming to the UK, but you could use things like excluded property trusts. So if you are coming from exotic countries like Hong Kong, America, Spain, and you're coming up to the UK, then you may have assets and you say, well, actually, I don't want those to be subject to UK inheritance tax. And using an excluded property trust will allow you to do that. It might be pretty costly but to set up, but actually, if it saves you 40% tax on the gross asset value or the market value for more point, then it's certainly worth you looking at it.
Yeah, I think it is.
My viewpoint. I just noticed how bad, because of our camera is positioned, the background of our video is also pretty awful. So we're going to have to do a makeover this weekend. So get your paintbrush out. Right. Okay, we've got some people asking questions actually. Let's go to that finally. We've got some you've volunteered. So great. So Francis Choi, can the deed of trust minimize inheritance tax, please? I mean, let's talk about what is a deed of trust.
Well, in the simplest of methodologies of explaining it from a tax advisor perspective, I'm sure I've got some solicitors going, oh, here she goes again. But in terms of very simple tax language, it allows you to move the income and ownership of an asset from one person to another without having had to sell it, technically speaking. And that could be very helpful if you're trying to think about maximizing out tax efficient rate bands, for example, between husband and wife, or spouses, quite frankly. That's when a deed of trust becomes really helpful. I wouldn't necessarily see it helping from an inheritance tax perspective, because unless, of course, you're trying to move assets way before death, obviously we all hope we've all got a long time. But the issue with most deeds of trust is that they become null and void when a life-changing event occurs. And normally life-changing events are death, divorce. Yeah. So quite frankly, you might be thinking you're putting something in place to move an asset, but actually it all unravels at the point of death, and you've actually not done the thing you wanted to do. So just be very careful about why and what you're using a deed of trust for.
Yeah, they're quite weak,
I would say.
In my view.
They're helpful for short-term tax tactics.
Yeah.
But I wouldn't use them as part of a strategy typically for inheritance tax.
I mean, the idea of a deed of trust is to transfer the beneficiary entitlements over, but it does trigger a stamp duty, land tax potentially, capital gains tax, and you also need to think about your banks. And, you know, if you have terms and conditions with your bank, say, well, you get the rental income, but you're now ousting it out to someone else. You could be in danger of breaching those terms and conditions with your mortgage. So just be a bit careful with those kind of plans. But yeah, for sure. Asma is here. Asma, good evening, Asma. Has asked, hi, I came across a client and his brother recently. The client has a limited company and receives rental income from a specific property. Maybe, Asma, if you can clarify that, because does the owner of the property, is that the individual, as in the brother, and then moving the income to the limited company? If so, that's GAR not allowed for straight, unless he's got a deed of trust in place, it's been legalized and everything's been approved. But you cannot move property income from individual names straight into limited company. Are you reading anything differently from Asma at all about this?
I don't think so. Hey, Asma. I think client has a limited company, receives renting for property. Send me some more information. Send us more information, Asma. Let's get our brains working hard.
Let's chew the facts. I think she has.
Give me some data. Oh, okay.
When I asked about the ownership, he said his brother owns the property. Yeah. So if it's going to a limited company, absolutely not. No, that falls foul straight away of GAR. So GAR is a way of getting a tax advantage from the everyday person who cannot.
The law was not designed to give.
Yeah, so it's not in the spirit of taxation, according to HMRC, whatever that means. But the idea behind it is, well, if you are going to be taxed in your own name at 45%, as an example, and now you move it to a limited company and being taxed at 19%, you have got an artificial structure in place, and therefore it will be void, and HMRC will tax that individual as though the income is back in their name again. The big concern I always have with that is, from a corporation tax perspective, will they give you the money back?
I think we know the answer to that one.
I think you're already in danger of the income tax double charge, and now you've got this thing of, well, can I get the corporation tax? Well, no, that's a separate issue. We're focusing on the income tax. You're going to have to take that up with a corporation tax team, and they're not going to listen to you. So Asma, I would kind of advise them not to do that, if I'm totally honest. I think Asma's continued with this. I say the brother wants a declaration of trust, so the client who owns a limited company can receive the income. Any comments? Can a declaration of trust work? And again, it goes back to my point earlier of saying, well, there could be a capital gains tax because you've given a beneficiary. Before you go on to this, there's two types of ownership in a property. There's the legal title holder, which is the person that that looks after the title of the property, and that's it. But they don't get any beneficiary entitlement. And you'll find this in trusts. So you'll find a trustee owns the legal entitlement, say that this asset, they will have the final say what happens with that asset. But the beneficiary entitlement may be the beneficiaries of the trust. Now, in the case of a limited company and say, well, I just want to move it to a limited company and not the brother, well, that there is no mechanism for that. There is no rights. And certainly, again, back to my point of buy-to-let mortgage fraud, which that technically would be, then they've got problems, to be fair.
Yeah, it's not an easy solution, sadly, to move the income from an asset between, if you like, the bricks and mortar of a physical person and a limited company. There are some ways to do it, but quite honestly, from what you've already described so far, which is fabulous detail, thank you, I think they're possibly in a place that they're not going to get this solution safely done and within the law, and it probably is something they need to go back and look at whether there's a different way. Not looking like it's something I would recommend to any client to do. And I know you're not recommending it, they've just come to you with that. But I think it's something they need to go back and review, because I don't think it's right.
Yeah, I mean, we've got so many references now from HMRC's 2018 manual of guard, and we've got probably 3 or 4 pages worth where it relates to this kind of mechanism setup, because you've got to think about the beneficiary entitlement. When you move the beneficiary entitlement, well, where's the SDLT? Where's the CGT? You know, the client is in danger of triggering those extra taxes that they weren't aware of, because they've used the deed of trust, which invariably says, I'm moving the beneficiary entitlement to another entity. Therefore, that could be if you move a property to a limited company, even though you gain no consideration, you are a closely connected entity, and therefore you get the 3% plus the normal stamp duty land tax as well. So they really are in danger, if I'm totally honest with you.
Yeah, definitely not something to do. It's a great question to have raised, and hopefully it's brought some key insights for others listening as well.
Yeah, so I think she meant deed of trust. We know what you meant.
We know what you meant, Asma, don't you worry.
We were there with you. We were there with you on that cold
technology not enabled, but we were there.
Yeah. So here's we go. Where can you find out about inheritance tax affairs in other countries?
Oh, lovely question.
Yeah, you'd have to pretty much go to the country specifically. I don't think there's any one literature. There's things like KPMG, Deloitte, Ernst & Young that will talk about those kind of taxes. It's always very high level. So when I've gone onto their websites, they are very good as a reference point, but you really do need to go back to the tax authorities in those countries. And it's a great way of looking at different countries and saying, well, actually, I'm going to live out the rest of my days in sunshine with no tax from inheritance tax. It could be really a good way of doing your life, to be fair. Doing your life?
Living your life. Being your life.
Yeah. Oh, sorry, that's Asma again. So let's just go on to Asma. Is Asma back? I agree. I mentioned Gar as well. There you go. There you go. So, but saying that, I mean, Asma, the one thing I would say, how many times have I spoke to accountancy firms that still talk about doing rent to rents? Okay, so that's another mechanism we see a lot of, whereby people think, okay, you have a limited company, you have properties in your own name. And back in the day, I was promoting that scheme. Don't use that word. But I was promoting that to say, well, in 2013, there was no GAR around. That was okay.
But rules change.
But rules change. And, that meteorite is coming to those accountants that kind of keep on spinning that yarn. We've just taken on a client who was having a difficult conversation with, because they were saying, no, I'm right because my accountant told me. Yeah, but your accountant's wrong. So ergo, you're sadly wrong. And that's a real horrible conversation to be having with someone, because they've been told that's what it is. And eventually, you're going to believe what you hear. So, it's an interesting one that you've come across, Asma, but it's not unusual, as Tom Jones would say. I want to restructure my limited company from ordinary shares, so to belong to me and my wife, and freeze the shares, A, B, C shares basically, My accountant is useless.
Oh dear.
We can do the restructures. I'm going to put a link to here and we can talk about that. So the thing about limited companies is that you can have freezer and growth shares. Louise, do you want to talk about that while I just get this thing up?
So there's clearly a lot going on if you are in this space and researching, and there's a lot of organisations talking about having, you know, adjusted structures of their business to take advantage of various things. And I definitely would recommend, if you're thinking, have I got the right structure, go and do some of that research. We've got some great articles on our website. We've also got some superb YouTube, what some people call smart businesses, others call simply restructures. We can look at those with you. The beautiful thing about share structures is, to a degree, it's as wild and as broad as you want to imagine. Growth and freezer shares are phrases used to describe two different kinds of share activities or share types you can put in a business. Often a freezer share is simply pretty much what it says it is. It freezes the amount of value associated with that share, no matter how big the business grows. So if you don't want a part of your business ownership to grow because you're thinking about inheritance tax, maybe that's something to consider. Growth shares, by almost the opposite, are shares that only kick in and only start to accumulate more wealth and value once a business hits a particular milestone. That could be turnover, it could be a matter of different structures. As I say, it's as wide as you want your imagination to flow and grow as to how you want to structure your business. So there's lots of things you can do, and those types of shares, you might say, well, why would they be of any value to me? Well, the first one, freezing your value of shares, might be a very sensible thing to do if you want to be planning for inheritance tax, or rather planning not to pay any inheritance tax. That's obviously an advantage. The growth shares are a great thing to put in place perhaps for younger members of your family or individuals that you wish to leave a legacy to, so they start taking ownership perhaps in a business, taking interest and accountability in a business with a long-term plan that, should they help the business grow to a certain size, they're the ones that are going to be advantaged by that. So there's all sorts of reasons that you might do these things, and it's about working through what's right for you and your family or your business partners, both now and longer term in the future, and then planning that through. And that's the kind of thing that we do.
Yeah. And furthering on from that, someone mentioned about international stuff, but of course I've been looking at Hong Kong Spanish tax as well as American tax. And those four countries are really interesting when you see the intermingling between the countries, because you could create a smart company in one country, but actually it's not so smart in another. So you have to be very careful with the company structures if you have international stuff going on. So I think it's very important for you to understand all of these things, but you also need to have that conversation with the mortgage broker as well, because we see a lot of clients that go to an accountant and they says, yes, we can make you tax efficient, give 30% shares to a child. Then they try to get a mortgage. It's like, no, you can't have a mortgage. You're going to have to redo everything you've done. And it's like, oh, right, okay. So there is a danger. I would say there's that triangle formation going on, whereby you are at the top, the apex, and then you have the accountant, tax advisor, and the mortgage broker. And we work very closely with a mortgage broker. We know the tax structures that work from a tax planning angle, but also from a financing perspective, and both are critical to get it right rather than overdo it and have to redo it. So I'm sorry to hear that you have these problems, but it's not surprising that that's going on. I'm just going to go to, there was a question that I had, maybe that was that one already. So I'm just going to go down then. So yeah, so here's the link. I've just put this in the description box. So if you can see this, this is the company formation. We do restructures as part of that service. So if you want to have a look at that, we talk in that page what the different types of shares are. And I think you've put a video in there, so as Louise said, so feel free to watch that. But there's a form to fill in if you want us to work with you to do that restructure. And just keep an eye, it's 9 o'clock, too bad with time. So what are the tax reporting and other ramifications for as resident opening up a UK LLP for UK property investing and trading most LLP income going to LLP sponsored SaaS whilst was that claiming expenses? Oof, I'm not sure.
So what are the tax reporting and other ramifications?
Saw the word us, it was lowercase. If you are an American and looking to set up a limited company, I'll speak of this one.
Yeah.
But LLP is a company similar to an LLC. Is the money from the company will flow through to your personal tax return. So if you're an American, that will go on to your US tax return. You need to do a 3025, I think, form to declare. You've got a partnership as well that you need to put in. But there are other issues with companies. If you use a limited company, for instance, you've got tax. Don't know if you know about that, but there are issues with that as well. So again, you know, setting up limited companies, accountancy firm says this is the best smart company you'll ever have, and then all of a sudden you look at it from an American IRS perspective, you say, well, actually, we don't agree with this, and you have to declare your US limited company and corporations on your 5471, 5472 forms. So you have to be very careful with that, because then they will tax you on it as though you received the dividends, even though you haven't distributed any. So get some really good tax advice, if I'm totally honest with you. Again, just don't listen to all the UK accountants on this one, because they just don't get US tax at all. And to be honest, CPAs don't get UK tax. I know that I've paid a lot of CPAs and got real bad advice, if I'm totally honest with you. So yeah, so get some good advice is my honest opinion on that. Anything to add from you?
No, I think that's a fair comment.
Okay, so let's move on. So let you read this one.
Hi, Naima. Okay, so interested in moving my various work-based pensions into a new SaaS. How soon after starting limited co would you recommend setting this up? I think this is more flowing to a pension advisor question than it is a tax advisor. You know, for arguably, once you have a limited company and it's trading, for want of a better phrase, it's actually doing something, that's the point at which you can start to engage and discuss in detail how to go about these things. And probably you've heard this already from one of our sessions, it ain't a short process to get a SaaS in place. So the sooner you start these conversations, the better. Even if the business is not yet progressed or to a stage where you could naturally start filling in forms, go have those conversations now if you haven't yet. You probably have already, but I would say go have those conversations with a pension provider to establish what needs to be done.
Not any pension provider. So I've just dropped you a link with a Zoho form. It allows you just to fill in an online form. We work with Kevin Wheeling from Wealth Builders. Fill that form in. We'll have a look, see what we can do. There'll be plenty of opportunities to set up that SaaS. But again, as Louise was saying, it takes time. It's a bit of a chess game. You're going to have to sit down, wait a while, because HMRC are currently taking about 9 months to do a SaaS pension opening. So it's not quick at all, to be honest. It's slower than actually setting up a new house. So hopefully that's helped.
We're going to put a space rocket in that time.
Yeah, exactly.
We just need Elon Musk on it.
So brilliant. So there we go. Thank you ever so much for that. They will come back and ask a question. So what tax would you recommend for a sole trader who's starting a new business in London? Have you ever been... I shall move away from that.
No, I think that's not the kind of question we want to be answering. Thank you very much.
Thank you. We'll move away from that. So we'll be funny on a live show. If it was the BBC and professional outlets, it would have been edited.
Amazing.
But it's not. So what's this one? So do you think Ukraine will impact the UK's tax situation? Also, have you been...
No, I think we'll move on again.
Oh, as another one. Right. Thank you very much. So thanks very much for those spammy comments, by the way.
Yeah, amazing.
Yeah, brilliant. Thanks for that. I've never had those kind of comments. Yeah, keep them to yourself. That's what I would say on that one.
Yeah, I'm not planning to do that with cheese.
Not on this occasion.
No.
So let's go to one ask question that I have.
Ooh,
and
go for it.
I'm going to ask you. So let's just have a look. Oh, so as it says here, As a follow-up, can you, in your firm, assist with your LLP setups? I could do one better for you. If you are looking for that, is to maybe look at our website. What I will do for you is put in a, I guess it would become a client. So
put in a link.
I think it'd be worth you looking at this page, because we do focus on US and UK tax. So feel free to have a look at that one. I'll just get rid of this page for you. So let's try that. Okay, so that's up over to you. So hopefully that gives you the link of that. So UK, US clients, feel free to put that through. All right. Question I had from Max: how does EIS investments help reduce tax, income tax, and CGT? And I know you love those, so I'm going to let you have the floor.
Oh, Max, you've made my evening. I love these kinds of things. So EIS, Enterprise Initiative Scheme. There's also a Seed Enterprise Initiative Scheme, SEIS. There we go. EISs are a superb tax relieving type of investment. Whether that type of investment is right for you or not is not something that we can comment on, but the tax benefits are really quite powerful. So for every £1 you invest in an EIS, you're going to get up to 50 pence income tax refund or a reduction in your income tax if you haven't yet paid it out. That will occur in the year in which you bought the asset, so whatever tax year it was. Alternatively, you can, if you choose, hand back 1 year. You can time travel. You've probably heard me say that phrase before if you're a regular listener, but you can time travel with this kind of relief as well. So if it's more advantageous for you to reduce your tax from a prior year, you can only go back 1 tax year earlier than the year in which you buy the asset. But if you do, you can use that to reduce the tax in that prior year instead. And if there's any left over, potentially you can bring it back forward again and then use up the last bit in the current tax year. So they're fabulous from an income tax reduction perspective. Sorry, for EIS, it's 30 pence in the pound. For SEIS, it's 50 pence in the pound. I just realised what I said. So it's fabulous. On top of that, there's a lot of other tax reliefs. One of which is that from an inheritance, I mean, we've been talking inheritance tax tonight, haven't we? But one of which is if you hold on to the shares, so it's shares you're buying in an EIS and an SEIS, if you hold on to those shares until your death, they will never form part of your inheritance tax death estate. Never form any, cause any inheritance tax on you whatsoever. Happy days. That's one of the other advantages of these kinds of things. There is also something called reinvestment relief for EISs, which means you are going to be in a place where not only can you have income tax relief on those benefits, you can help minimize your capital gains tax as well. Something slightly different, similar for seed enterprise initiative schemes as well. The downside with the capital gains tax relief is you're delaying when you pay the capital gains tax. You're not getting rid of it with an EIS, whereas with an SEIS, you are completely removing it forever. There are ways to make sure, of course, that you don't end up picking up capital gains tax and, if you like, unfreezing the relief in the future should you sell the asset. Through with an investment advisor, which are right for you and whether this would be longer term or shorter term. But great question, Max. Thank you for asking.
Now, well, I'm not sure about that. What do you think? Should we show that one or not? Not appropriate.
No, sadly, I don't think that we've got much of a comment to have on that.
Yeah, I don't think we. Some people are asking about politics. We're not here to make some politic comments. If I'm totally honest with you, we can help you talk about things we know about, which is
we don't know a lot about cheese either. Sorry.
Yeah, or any other animals. I do dropping off, and that red bar does worry me. So thank you ever so much for tonight. And I apologize if we, hopefully we got through all your questions. So that'll be a good start. But do join us again next month. We'll be doing this. Well, that time we will be in Marbella. So that'll be even worse.
I dread to think. I'm so sorry, people.
Yeah.
Lo siento. Lo siento. That's all I'm going to say on that matter.
So yeah, so that's the end of that. So thank you ever so much for joining us tonight, and we'll see you in a month's time. But don't forget to go to our YouTube channel, subscribe, check out the videos that we launch pretty much every day or every other day now. Property Expert Panel, #Nuggets of Gold, first Monday of every month. So make sure that you join us on there. But until then,
good night from me.
And good night from me.